I've seen a lot of people making claims about putting sell limits on their shares so that they can't be lent out to the investors that are shorting. However, I don't think that this is going to have nearly as big of an impact as a lot of people think. And I'm going to go over that for a few reasons why GameStop is different than, let's say, AMC or BlackBerry on this front. So, I think it's a good idea putting an order so that they can't be borrowed out. However, I don't think it's the whole picture. One of the bigger concerns that I have is I don't think they're getting squeezed as much as a lot of people would like to believe. There is a lot of pressure being put on them on the price front, but as far as share availability goes, I don't think that's as much of a concern. You can see on iBorrowDesk, the fee is not especially that bad. Of course, 32% a year is pretty ridiculously expensive, and anyone who is borrowing is making a really nice premium off of it. However, if we go into the actual holdings, like who owns GameStop, this to me is pretty crazy. We have 122% of shares being held by institutions. So if we're assuming the amount of shares outstanding is about 140, 150%, which was the numbers that we were seeing for the short. Let's say 250 is the existing float. Well, half of that is being held by institutions, and if you think BlackRock isn't going to gladly take a free 30% from borrowing, I got bad news for you. All of these large funds are probably making an absolute killing off of what they're lending to the hedge funds in order to keep them from going under. They can basically charge them whatever they want because share availability is so low. And this is really different from AMC or BlackBerry. I'm going to show that here. Only 40% held by institutions for AMC, a little bit higher for BlackBerry, it's around 50%, and Nokia is even lower. So there's almost no institutional holdings for Nokia. However, I think GME is in a unique position where there's already over the total regular amount of shares that's being held by institutions. So the institutions themselves can put a lot of pressure on the hedges that are shorting. So I think this is going to be something that is going to have to be a slow burn. I'm worried that the current frenzy that is going on is going to make people lose interest, or they're going to move on fairly quickly, because this is not going to be something that is sustainable unless if everybody kind of calms down and actually parks their money where it's at. But just know that all these hedge funds are going to be lending out their shares. They're going to be making money on both sides, and they're going to be the ones that are making the best gains. They were in very early, and they're doing exceptionally well. That doesn't mean there wasn't a lot of people in retail trading that did, fairly well for themselves. But I think everybody needs to focus on the fact that this kind of thing is a lot more fragmented than the Volkswagen and Porsche, where it was mainly one big company coming in and facilitating the squeeze, whereas there's a lot of smaller players as well as a giant retail section, which is going to be really hard to coordinate. Whereas with one big company coming in and doing a squeeze, they you don't have individuals working against each other. Because let's say if all the big institutional holders and mutual fund holders decided to do the same thing, they probably could squeeze the price up to $1,000. However, I think a lot more of them are more willing to lend out shares at exorbitant prices and take the guaranteed funds rather than hoping that they can be the first one to exit out of uh, a position that just blows up into the stratosphere and then tanks back down. I think they're much more willing to take the guaranteed money and see how long they can stretch it out for. But don't let that take your eyes off the prize. Melvin Capital's already down a lot of money, and the other shorts are as well. There is a lot of money being made here, and retail traders are taking the reins, and I'm glad to see it. Just one thing that I'm worried about is how much of these positions that the hedge funds that are going short are going to be doing off market, just because they do have the option of selling their shares without going through regular markets or buying shares back. It's going to be interesting to see how this goes down. I feel like there's going to be a lot of new regulations put in place. If there's one that I would like to see is a little bit more transparency as far as shorts go. I think knowing who is short on things should be treated just the same way as when you have to disclose your positions for long positions, or if you have calls or puts open, the idea that shorts have this preferential treatment to me is just kind of weird, and I hope we see an end to that. But thanks for sticking into the video. I know it was a short one. I wanted to get it out quickly just because I haven't seen a lot of other people talking about this, and I do think it's a really important consideration that a lot of people aren't talking about.